Okay, so let's talk about the black sheep of life insurance, universal life. Some people think it's a scam, others think it's a tax shelter. Some advisors treat it like a secret weapon, others avoid it like it's radioactive. So, what's the truth? Here it is. Universal life insurance is like a financial Swiss Army knife. But the problem is, people try to use it as a hammer. Let's break it down. At its core, universal life is still life insurance. There's a death benefit. Your beneficiaries get paid when you die. But the twist? There's also an investment component. You pay a premium. Some of it covers the cost of insurance. The rest goes into an account that grows tax-deferred. Simple? Kind of. But here's where it gets messy. Unlike whole life, which is rigid and bundled, universal life is flexible. Too flexible, actually. If you don't know what you're doing, you can change your premium. You can overfund it. You can underfund it. Universal life isn't just about premium versus benefit. It's about funding strategy. It's about long-term discipline. It's about making sure your client doesn't let the policy implode 15 years in because they thought it would just grow on its own. There are a few types of people universal life can be a great fit for. High-income earners who've maxed out registered plans. Business owners looking for a tax-sheltered cash value. Parents who want to fund future needs and leave a legacy. Clients with complex estate planning needs. But don't force it. Not everyone needs a financial Swiss Army knife. Some just need a clean, sharp kitchen knife that does one thing well. And here's a common trap. People get obsessed with the investment side of universal life and forget that it's still a life insurance policy. If they just wanted growth, they'd go buy a portfolio. Universal life only works if the insurance component is also part of the plan. Let's talk numbers for a second. Most policies come with a minimum and maximum funding range. You can pay just enough to keep the insurance alive, or you can overfund it, stuff it with cash, and watch it grow tax-sheltered. But guess what? If you underfund it and don't monitor costs as you age, your policy could crash right when you need it most. Universal life isn't passive. It needs attention. It needs reviews. It's more of a partnership than a product. So here's the bottom line. Universal life insurance is not broken. It's just been badly explained. Used right, it's one of the most powerful life financial tools available in Canada. Used wrong, it's a recipe for confusion, disappointment, and awkward phone calls 20 years later. If you're a client, ask questions, demand projections. If you're an advisor, know the mechanics and don't skip more. Because universal life isn't about hype. It's about long-term planning with purpose. So no, it's not for everyone, but for the right person, with the right strategy, and the right guidance. Universal life insurance isn't complicated. It's just custom. And that can be a very good thing. You can invest in indexed options, GIC-like options, or even equity-linked accounts, which sounds empowering, until you realize your insurance plan just turned into a side hustle. Now, if you're a consumer, here's when universal life actually makes sense. You're already maxing out your RRSP and TFSA. You want permanent insurance, not something that expires at 65. And you're in a high tax bracket, looking for long-term tax-sheltered growth. You're not just protecting your family, you're building a tax-efficient estate. You're planning decades ahead. It's not for everyone, but for the right person, it's brilliant. Now, if you're an advisor, listen carefully. This is not a plug-and-play product. You don't sell this with a glossy brochure and a smile. You have to educate. You have to model scenarios. You have to stress test assumptions. Because if the client doesn't understand the flexibility or the risks, it becomes your liability.